Hi there. In this short topic video, we're going to take a look at two more external sources of finance for a business: hire purchase and leasing. Now, when you look at these two methods of finance, you'll see that actually the cash flow effects are quite similar, and they involve a similar concept, which is the spreading out of payments over a fairly long period in return for using an asset, both of which have cash flow benefits to a business compared with buying an asset outright. However, there is a subtle difference between the two. Hire purchase involves buying or owning the asset that you're paying for. So the hire purchase is an agreement to own the asset, sometimes with a final payment at the end of the agreement, which completes the hire purchase period. Whereas leasing, you never actually own the asset. You're simply, if you like, as a result of the payments to the lessor, you're gaining access or use of the asset. The asset is ultimately owned by the organizational business that is leasing it to you. So with HP, you get to own the asset, provided, of course, you make the payments. With leasing, you don't. You get use of the asset, but you don't own it. It's a subtle difference, but quite an important one. Now, let's just quickly spend a couple of minutes thinking about HP. We've mentioned that this is a method of buying goods, buying assets, by making installments or payments over time. So rather than paying a big amount up front, you pay over installments. Now, the key features of HP are that often the agreement is structured so that the bigger cash flows can be towards the end of the HP agreement. Sometimes it's what's known as a balloon payment at the end of the period, where you gain the final payment to gain full control of the asset. It's very flexible, so you've always got an option when to make those payments. And I think more importantly for a business, a very large range of assets can be financed or purchased using HP. It's not just about cars. So for example, whilst company cars are often bought on HP, as well as, of course, via leasing agreements, you can also use HP to buy things like photocopiers, large office equipment, but also machinery, plant and machinery for the factory. So HP is a very common way of financing the purchase of what you would know as fixed assets, plant and machinery, or capital assets. Leasing is a slightly different concept. We've mentioned that leasing means you don't actually own the asset. You're simply making a payment to the lessor. So think of leasing as a form of rental. You're renting an asset, you gain access to the asset, you can use the asset. In other words, you have beneficial use of the asset, but you never own it. Now, the key benefit of leasing, which is similar in some respects to HP, is that the leasing agreement gives you very predictable cash flows, and you're spreading the cash payments over a fairly long period if you wish. Another benefit is that the owner of the asset, the lessor, actually carries the risk. If the asset no longer works or needs to be replaced, it's the lessor whose job it is to replace the asset. And also, generally, a leasing arrangement involves a lower interest rate than, for example, taking out a bank loan to buy the asset. So it can be quite a low-cost way of financing asset access. Leasing is very widely available. It's a very popular form of structured finance for a business. Some of the downsides, well, obviously we've mentioned already that you don't actually own the asset. You're simply gaining access, beneficial use of the assets. And of course, you've always got to be careful, haven't you, with leasing contracts, long-term contracts of any sorts. And sometimes they're quite difficult to cancel. There may be payments involved if you wish to get out of the lease. So you always have to be slightly careful that there aren't onerous elements to the contract. And also, occasionally, the lessor may require an upfront deposit, which may have a cash flow implication. There we go then. That's a brief introduction to two very popular, widely used sources of finance, both of which are external sources of finance: hire purchase and leasing.